Okay, so the first thing we're going to do is, in response to I think Garvit's request or Bharat's request, that we show you how to place these bracket orders. Okay, so you can place bracket orders, and I think that's a good thing, because it will put you into this habit of thinking constantly about the stop loss and the take profit. Okay, so initially we'll train you in that manner. Later on I'll show you why you don't even need a take profit. Okay, so we'll remove one element of the problem. So let's do that. Let's try and place a bracket order. So one of the ways you can do that is you can just say, let's say I have a bracket, I want to buy Maruti. Okay, so I'm not even going to look at the chart, so I just click on the offer. Okay, so I have a limit order set up. Okay, so what I can do is so the limit order, if the market price of Maruti is 55.21, the limit order to buy will be above or below? Right, everyone's clear about that? So it's below. Okay, so it is it's below 55.21, so let's make it like 55.01. okay, so we have an order to buy at 55.01. all right, so now this is your plan, that you want to buy Maruti at 55.01 when the market is trading at 21, and now you're going to place a bracket. Let's say it's only 400 shares. We're going to change this obviously to GTC. Okay, so these parameters are okay. Now before I transmit this, I can right click on it and do an attach. Okay, and I can just see here there's an option. Yeah, so here you see that I have an option of bracket orders. So the moment you click on bracket orders, the system is very smart. You see that your initial buy order was 55.01, right? So that remains, and then the bracket orders are both sell orders. The system is very smart because you chose bracket orders. So, and automatically you can see that one of those, one is a limit and one is a stop. You can see that, right? Although it has maintained, both are sell orders, both are for 100 shares. So the system has also maintained the equivalence of amounts, because it saw that your limit order is for 100 shares. Okay, so therefore it has also maintained the equivalence of amounts. Is that clear? Okay, so everything is taken care of. Now all that is left for you to do is, and it's also maintained the GTC from what you set. So make sure you set all the parameters in the limit order first. Okay, and then you can set this. Okay, so then when you've got this, everything is set. So all you have to do is you have to now, which is the take profit here? The limit, or the limit one is the take profit, right? So this should be higher than 55.01 or lower? Higher. Okay, so let's be very ambitious and let's make it like 5700. Okay, so we want to take profit at 5700. Okay, and then at 55.01 we want to put a stop somewhere. Okay, so the stop this is called the stop trigger level. Okay, this stop level is called the stop trigger level. Okay, and this is called the limit price level. You can see the prices a little better. Okay, all right. So the stop trigger level, this should be below 55.01 or above? Below 55.01. Okay. So let's make, to be very simple, let's make it like 45. No, let's make it like, that's too much actually. So let's make it 49.50. Okay, just whatever. I mean, you can have it at 49 also. But okay, so is this clear now? So we are listing about 50 rupees per share, 51 rupees per share, 52 rupees per share. Okay, around 50 rupees per share is our risk. Is this clear? Okay, and you can see here that I'm following the general advice that I gave you. We will look at later on. We will look at how you can make this more systematic. The multiple, the choice of the multiple. Okay, which is that essentially you can see that the take profit is very big. Okay, the targeted profit is very big compared to the targeted loss. Is this clear? So this is the broad principle that you have to follow. Yes, you have the mic.
It's 550 per share.
Place and buy 550.
Sorry,
Your risk range is 550 per share, not 50.
So it should be 450,
Oh yeah. Sorry. This is not. I read this as 0 essentially. Yeah. So this has to be. Good. Tarun is very observant. Okay. So this should be 5450, right? Okay. Good. Very good. So at least we know that somebody is paying attention to the detail, right? Okay. And attention to detail is very important, because when you're placing orders and stuff like that, you may make mistakes. Okay, so right. So is this clear? Now, what was I saying? So the idea is that the size of the take profit is very big compared to the size of the stock. Okay. Now, how big? That we can look at. There's no fixed answer for that. But the general idea that it always should be very big. The take profit should be much bigger than the stop loss, the size of the stop loss. This principle should always be followed. Okay, how big we'll look at. There's no fixed answer, but we'll look at how we can determine ways in which we can set that in a more systematic way. So everything is clear now. Okay, now all you have to do is you have to just transmit one of the orders. Just click on transmit. Okay, and I'll just show you one more thing before we look at the orders here. It's a session outline. Yes, Garvit. This is, I think, too much.
Sir,
Yeah.
my question is that if the price does not reaches the first limit and reaches directly to the second limit, that is 5,700. So the shares will be sold.
One minute. Oh, sorry. If the price. So here we have. Understand the structure of the bracket order. So the bracket order is. I discovered that they don't let you enter bracket orders with market orders. Okay. You can only enter it with limit orders. Okay. So you can either use this technique that I've shown you here. Okay. And or you can use. There's another technique through the order entry dialog box. Okay. So we are using this. So this is good enough. Then you can figure out for yourself if you want to do order entry. But this, I think, is more structured. You start with a limit order plan and then you put a bracket order. Okay, yeah. Now, what's your question?
Yes, sir. My question is that as we have put the price of limit 5501, but
Okay.
the share price is 521. So
No, it's 5523.
Yeah, 5523. If the price rises to 570040, as we have quoted, so my shares will be sold or not?
No.
That's
No. So the character is a good question. Okay, detailed question. You understood his question? He's saying that if before exercising your limit order, you have to enter the position, whether if the price goes directly to 5700, okay, whether the 5700 sell will be executed. Yes, Parul, what is your view?
Actually, when it makes 5700, it will be automatically buy on 5501.
How can it buy at 5501 when the price is 5700? What Garvit's question is, if the price reaches directly to 5700, okay, if the price goes, see here now the market is 5523. Now when the market is 5523, I placed a buy order at 5501. Okay, so what Garvit is saying is that what if it never comes to 5501, it goes directly from 5525 to 5700. Will it get executed or not? Yes? No, let's see what Parul has to say first. Mike?
Is there can be a reverse order like first?
No. Don't ask another question. First answer Garvit's question.
So, no, I don't
Yes or no?
It will not be paid.
It will not execute. The 5700 sell order will not execute. Anybody else with a different view? Yes? So everybody feels that it will not execute, right? Yes?
Is there a possibility for
No, don't give all these questions. Simple question that Garvit has asked, that if the market goes directly from 5523 to 5700 without ever coming down to 5501, will the 5700 sell order be executed or not? Simple question, yes or no?
No.
I'm asking Chuk now. He's asking all kinds of questions. You're supposed to answer this question, yes or no? Okay, alright. Okay, so they are right. It will not execute. So the structure of the bracket order is that the limit order is treated as it's a primary order. Okay, so the bracket order exists only to cover the limit order. So unless the limit order is executed in the first place, the bracket order elements will not execute. Okay, is this clear? The bracket order elements of the bracket order only kick in once the limit order is executed. Is this clear? Is everyone following? Some of the faces are not very encouraging.
Yes.
They don't seem to be enlightened faces. Yes, like Burma, Pritesh, the faces are not enlightened. Okay. So now what we do is, everyone is following?
Yes, sir.
Okay. So I just have to transmit this one, okay? And I'll give you some messages about equity with loan and all that. Here you can look at some of the questions. One of the questions that Chuk was focusing on, what is the value of my position, okay? If I'm planning to buy 100 shares of Maruti, this is the value of my position, estimated commission, okay? You have to actually go to the IB website and read up the commission structure. This is part of your training. Whenever you're trading with any broker, every broker will have their own commission structure. Okay, so you have to, one of the things you'll have to do is go to the website, look at the commission structure, and there are some variable elements to the commission structure. Like you get this concept of volume discounts. Okay, so if you're trading a large volume of shares, it's not a simple formula like just 1 rupee per share or something like that. Because if you're trading a large volume of shares, beyond a certain threshold, you will get a volume discount. So the formula for writing the brokerage on a particular trade is not going to be simple. When you write it in a spreadsheet, it's not going to be simple because it has to cater to the volume discount. Are you following what I'm saying? Right? Yes. You're not following. You don't understand what volume discount is.
Yes,
if you buy one laddu, it's 50 rupees. But if you buy 5,000 laddus, you will get a discount. It's not going to be 50 rupees per laddu. Right? So volume discount. There's a moment I said laddu, she's thinking of answer sheet. What marks she'll get. Okay. Now, is this clear? Volume discount. Okay. So which means that formula is not going to be simple. If you buy 5,000 laddus, you just can't multiply 5,000 by 50. You'll have to factor in the volume discount when it clicks in. So maybe after if you buy more than 1,000 laddus, you start getting the volume discount. So no, it's not really like market lot. It's not exactly similar to the market. It's just simple volume discount. I think all of you are familiar with business. In every business transaction, the concept of most business transaction will have a concept of a volume discount. That on your first 100 units you will have to buy at this price. It depends on how it is structured. It can be structured in different ways, right? So this is the concept of a volume discount. So the point I'm trying to make here is that when you program the brokerage element of when you're projecting the brokerage as a function of the size of the position, it won't be a very simple formula because most brokers will have volume discounts. So you'll have to program that into your spreadsheet, right? Okay, so you can get an estimate of your commission, okay, and then you just transmit, okay, and it's giving you the normal warning about the stop order, okay. It's just warning you because stop orders have some problems because you may not get the point here is that essentially they're telling you to look at the risk associated with stop orders. The problem with stop orders essentially is that even though your stop is at 54.50, okay, the main risk they're warning you about is that if the market actually goes to 54.50, okay, the eventual execution of your sell order for 100 shares at 54.50 may not eventually get done at 54.50. It may get done much lower. It may get done at 54.25, okay, 54.20, 54.50. So there's no guarantee. So there's the point about the stop order, which we'll see later on when we understand the stop orders. We look at the various types of orders. Right now we've only looked at the definitions of the orders, right? Give her the mic. She really needs a mic because her throat is not in good condition. Yes. Yes. I heard the first part. So if it is not going to execute, if there is no guarantee of execution at 54.50,
then what is the point of keeping a stop?
No, there is a point. We'll explain that when we get into the details of the stop order. Okay, there is a point because if you don't even have a stop order, then the point of the stop order is at least that at 54.50, the process of selling your shares will start. If you don't even have a stop order, there's nothing to even start that process. The market is just moving against you and you're on holiday, right? So there's no, so there is a value to the stop order. We'll see what happens when we look at the details of the stop order. So is everyone clear now how to place bracket orders? Okay, so it's a good way to approach your trading. You can just look at the market, form a view, okay, and then like here I had gone in here. So if you place a limit order, whatever, even if you want to buy now here, place a limit order here, place a stop loss maybe here or here. This is actually logically more correct, and then place a take profit much higher. Okay, all right, so we got this element cleared. Okay, the element of the bracket order here. Yeah. Yeah.
Sir, I was asking that at 54 that you price said that the order will be placed. But if I...
You're talking about the stop now.
No, yes sir. The order will be placed. But
No, one second. Which one are you talking about? The stop?
Yes sir.
Okay.
But when I get to know that when I just need to buy at 54, if I assume that the market price has gone to 54.50, then I need to buy just now. My order will be placed right now only, no?
No. 1 minute. I'm not able to follow the second part. You're talking about the stop order, and now you're talking about a situation where the market price goes to 54.50.
54.50, and my stop order is being placed at 54.50, but I got to know that the market price has gone that much. But if I place the order at that time, if I go to the market or I go to the broker and I place order at that time, my order will be processed before that or after that? I want to ask.
No, I'm not able to follow what you're saying. But first of all, you don't operate like that. See, if you've already placed a stop order at 54.50, we are ignoring the decimal here, okay? But if you've already placed a stop order at 54.50, you notice that all three are green.
Yes, sir.
Okay, order is waiting to trigger. Okay, so all three are green. So therefore, the broker is already watching a stop order for you at 54.50. Now, when the market actually goes to 54.50, you don't have to again go to the broker and tell him to sell, because you've already given him instructions. These are a conditional instructions that you've given him, right? That if your temperature goes above 32 Celsius, then switch on the AC. Then you don't have to separately, when the temperature goes to 32, again have to go and tell him please switch on.
But sir, in that process, that if I told a broker he switches off late, but my switching off is early, so
No.
I can go and switch
There's no late. You can't be faster than the broker by definition, because
I just wanted to ask.
no, you can't be faster because you already told him this order is being watched by the broker. So as soon as the trigger price is hit, which is the market trades at 54.50, as soon as it's triggered, okay, the basic structure of a stop order, okay, we haven't even defined market orders fully yet, but the basic structure of a stop order is that the way it works, it's like a conditional market order, okay, that as soon the way the system understands it, now you'll get to start thinking in terms of system logic as well, okay. That is the system logic for a smart stop order is this, that as soon as, and because it's a sell stop order, so I'll discuss it from the selling point of view. So as soon as the market hits this 54.50 trigger, okay, the system is going to watch that trigger being hit, and then the system will immediately react by transmitting a market sell order. Okay, so basically what a stop order is nothing but a conditional market order, which means it's not a pure market order. A pure market order will immediately go in and sell. Okay, so what a pure market order does is it immediately goes in and sells. Okay, so if I have a pure market order to buy NSA HDFC, okay, I may not be able to get it at 81.40, but as soon as I transmit, immediately the system will go into the market and buy. Okay, but it will buy at any price. It will say whatever the market price is, I'll buy it, not necessarily at 45. It could be better than 45, it could be worse than 45. That's a market order logic. Okay, immediately go into the system, into the market and buy at whatever price is prevailing in the market. Okay, that's the market order concept. And then the related concept of the stop order is that a stop order is basically a conditional market order. It is not directly transmitted right now, but because you've given him a condition, when the price hits 54.50, then you sell my 100 shares. So essentially what the system will do, once this trigger is activated, right, the market trades at 54.50, the system will transmit a market sell order. Okay, and that's why your price is not guaranteed. So we're going to come into that. Are you following now? Okay, so you can't be faster than the market because you've already placed it now. Okay, it's not humanly possible to be faster than the technology. Right? Are you following? You don't seem very convinced.
Yes, sir.
What is the? Yes, are you convinced or not?
Yes, sir, I am convinced. But I am not convinced that it is not, it cannot be possible because if we go on, if you see that
Give him the mic, yeah.
if the technology will be selling at a lesser price than this also, then why should I go?
No. Because see, there is also the concept of queuing. So essentially, the system is watching the market prices. Okay, as soon as the market trades at 54.50, so you can't get to know before that. So you and the system get to know at the same time when the market trades at 54.50. And now think about it. You can only interface through the system. You can't directly put your hand into the server and manipulate it, right? You have to interface through the system. So think about it that both of you get to know at the same time that the market has gone traded at 54.50. So in that case, the system has already got a pre-programmed logic that I have to transmit a market sell order for 100 shares. So the system has already done it in a few milliseconds, right? Then if you are trying to beat the system, you have to then again enter a sell order. You have to again click on this and enter you have to do all this market sell order, okay? And you can keep it as day itself, it doesn't matter. Then you have to click transmit. So you can't be faster than the system. Are you convinced now?
Yes, sir.
Okay, good. That's a much more, your voice is filled with a lot more conviction. Okay, is everyone clear now? Yeah. Good. So yeah, but it's good that he's asking all these questions, because whatever questions arise in your mind, you should ask. Otherwise, you don't get to really learn. Everybody has to learn in their own way. That's why it's really important to attend class, because you get to ask questions. Okay. So yeah, so feel free to ask questions. Okay. Yeah.
Sir, if we are dealing with 1,000 or 2,000 shares, so when we initiate a buy order, so it takes some time, 5 to 10 seconds.
Yeah.
So if the market, if there is a huge slump in the market downtrend and the price is falling with a huge pace, in that case, if we are selling, the system is selling the order and it takes some time. If it's taking time in buying, then it will also take time in selling.
Yeah.
And in that case, when the transaction is in between, the price fall to say 4530. Oh sorry, yeah, 450 something around 5300.
Yeah.
So in that case, my order will be sell on 4550 or in between.
Yeah, whatever it gets. Okay. Whatever it gets, because when the system is transmitting orders to the exchange server, there are other people also submitting to the exchange server. That's where the concept of speed comes in. How fast does your system order go to the, how fast can this guy, TWIB, communicate with NSE, the NSE server, okay? So now there are other people, that's why people were trying to co-locate their servers with the NSE servers, because they want to get those milliseconds advantages, okay? So that's where now there will be a concept of a queue. So the NSE server will look at a queue. So as soon as the price goes below 54.50, a whole bunch of orders are being transmitted. Some may be buy, some may be sell, okay? So some orders are being transmitted. So if you look at the sell orders alone, the market sell orders, there will be a queue system applied, okay? So the NSE server will execute the order on a first in, first out basis, okay, in the queue, okay? So depends on how fast your broker has been able to transmit this into the NSE system. Okay, so eventually that's why in any market order, and remember stop order is nothing but a conditional market order. Okay, so eventually it operates like a market order once the condition is activated. Okay, so therefore that's why there's no guarantee in a market order. There's no guarantee of the execution of there's no guarantee about the price at which it is executed. It could be anything. If the market is falling sharply, that's why they warn you. When you are using stop orders, that's why they warn you, because they may want to make sure that you understand that your stop order need not be executed at this particular stop trigger level. It could be much worse. It depends on what the situation is. That is one of the reasons, if you remember, I've told you to always operate if you're trading Indian equities, and if you're trading in India, what I tell people is don't bother trading all these stupid currency markets and all which they have on the NSE. They're like a joke basically. Okay, so the only market in India that is worth trading is the cash equities market. Okay, NSE, BSE, that's a liquid market, pretty liquid market, more liquid than anything else. Okay, and there too I have told you to confine yourself to the Nifty 50 shares. Don't go into all kinds of big companies which are listed, okay, because the volume is not very high. Those are not liquid stocks. So when you try to execute stops on those stocks, you can have a lot of, this is called slippage. Okay, this concept is, we are learning about something new, so I'll just put it into the, so this concept is essentially called, since we are today is okay, so bracket orders we covered. Bracket orders, I'm going to use the shorthand. Okay, market shorthand for orders is ODAs. Okay, bracket orders we covered. What else did we cover? Okay, I haven't come to the other part. We're looking at the execution, but basically we're covering market orders also, the market orders and stop orders. Okay, so what was I going to tell you? This okay, slippage. The concept of slippage. Let's look at the concept of slippage. So slippage is basically the difference between stop order trigger level. You understand? This is the stop order trigger level. Okay, this is the level which the system is watching. Okay, so that it's going to transmit the market order only when this trigger is activated, and that is the market trades at level, and final price at which okay, are you following? The concept is clear. The example that Bharat is giving, your trigger is at 54.50, but maybe there's heavy selling in the market and you're selling a lot of shares. Okay, maybe the final execution might be at 4,500 even. You don't know. There's no guarantee. Anything can happen. Okay, markets can move. That's another thing in the markets is there are no limits. Okay, as such, I mean the exchanges set some limits like 5% circuit breakers and all that, which I think is kind of stupid actually, because that's what most people do. Most exchanges do that. Even in the US they do it. Okay, but I think it's an anti-free market concept. The market should be allowed to operate. It will fall 20%. Fine. That's the market. That's life. Okay, but anyway, most exchanges have some circuit breakers, but it can still drop a lot. Okay.
In case of circuit break, so the market is shut off.
Yeah, they halt trading for a while. They halt trading for a while and then they resume.
Regular shares or
yeah, whatever the market. You can have circuit breakers in individual shares, in stock index futures, in commodity futures. Okay, so in certain cases where there's a massive mismatch of supply demand. Okay, so here we say when you have everyone understands what circuit breakers are, yes, sir. Right? Circuit breaker is essentially where there's a massive fall in the share. So the share price falls 20% in a single day, the exchange will stop trading. Okay, that's why essentially they're saying this fall is too much. There's panic in the market. Let's try to reduce the panic by stopping trading and see that maybe people have a cup of coffee. They become a little more relaxed. Okay, so that's the idea. So, but in situations where you have in the commodity markets, okay, we've had cases in the US in years past where there's a severe supply demand imbalance. Okay, because basically the price is moving sharply. Why? Because there's a severe supply demand imbalance. Okay, there is either way. Okay, so you have these situations. So when the prices stop, when the market stops trading, okay, we say that the market is locked, limit down. Okay, so we have operations of so this is slippage, you understand. Okay, so we have what? Circuit breakers. Circuit breaker stops market operation, essentially trading. Okay, so we say that the market is locked, limit down or limit up, whatever it is. Okay, if the price has fallen, we say it's locked, limit down. If the price has risen, we say it is locked, limit up. Okay, so the market is locked in the sense it can't trade because the exchange is not allowing trading. Okay, so then if you have these situations like when you have severe supply demand imbalances, you have cases in the US in commodity markets where the market has been locked, limit down for 3 days in a row. So what happens is like one day it drops, let's say 10%, and that's a limit on a commodity price. Okay, then you lock the market, you stop trading. So the market is locked, limit down. The next day it opens and again goes 10% down again. Okay, and again next day it opens, again it goes. It's just showing that the market, there's a severe supply demand imbalance. Okay, so it would have been better in my opinion to have the market drop and let it drop 30% in one day. In fact, I think it creates more panic. We never know really what will happen. But I personally, I'm not a fan of these kind of methods. I'm not a fan of anything that interferes with the free market, because I think these are stupid measures basically. So anyway, but that's how that's how it operates in most countries in the world. Okay. So
there is a circuit break and market is shut. So in that case, we can set new orders, and we can apply new. In that case, we can order when the market.
That you'll have to see with the broker agreement, because it might be that depends on how then you have to really go into the fine print of the technology agreements between the broker and the exchange, because there are some problems here. Because if I've already transmitted the order, as soon as the price went below 54.50, it may not have locked down, limit down immediately, right? So as soon as it went below that, my system logic has already transmitted the order from the broker server to the exchange server. Okay, so I think what you're looking at is you're looking at a situation is like, suppose the price is locked limit down, goes to 4,500 and is locked limit down. Can you cancel this stop order and place another order? That's what you're thinking, right? So there may be I would suspect there may be some problems with that, because you have to see the agreement between the broker and what the broker tells you. You have to really look at the fine print of this situation, okay? Because there is going to be a problem, because the transmission of this order has already happened. Now already gone to the exchange server. Now what does the exchange do? You have to really look at the exchange policy with respect to days when the market is locked limit down. Does it cancel all the sell orders? Okay. The exchange has an incentive to do that, because they want people to reconsider, right? Because if there's a selling panic and there's lock limit down and you guys have sell orders, what the exchange would really like you to do is basically reconsider your sell orders and maybe not sell right now, so that the selling pressure is relieved. So, but you have to, difficult to say in advance what will happen. You have to really look at the exchange agreements with the broker, what the broker tells you to do in these kind of situations. Okay, so there's not a clear answer to that, right? This is clear? Okay, all right. Okay, are we following now? I hope you guys are not switching off. We are getting some good questions. Okay, so it's helping you to understand the nuances of the subject. Okay, all right. So what else that we've learned? Some new terms. Market is lock, limit down or limit up. We've learned about circuit breakers. Okay, we've learned about slippage. Everyone is clear about slippage? Okay. So essentially, the reason I tell you to go for liquid markets, okay, is that in liquid markets we expect low slippage. Is this clear? In liquid markets, like if you look at currency markets, or even in India, if you're looking at, these are the most liquid markets we have in India, the cash equities market, but only the top shares. Okay, that's why I tell you to confine yourself to the Nifty 50, so that you're trading in liquid shares. So you understand this concept of liquidity. Essentially, that the definition that we gave is the ability to sell large volumes, transact in large volumes without moving the price. Okay, so it's consistent with that definition of liquid markets. So liquid markets, you have low slippage. That's why when you're running a speculative trading program, okay, like you're managing a fund or something like that, it is better to stick to liquid markets, because one hopes that you will use this methodology of stops to control your risk. And when the stop is triggered, if you're trading in an illiquid market, you can have very high slippage. Is everyone clear about slippage?
Yes, sir.
It's an important term, okay? That and so therefore that's why I tell you to operate in liquid markets, because it will control your slippage. And at the end of the day, when you realize this whole business of trading, being able to speculate without blowing up and losing all your money, the most important way you control your your risk is through stop orders, okay, by which limit your risk on each trade. And by having low slippage, you are able to ensure that your actual loss is close to your budgeted loss. You understand budgeted loss? We did the concept of budgeted loss, that you take your initial capital, whatever your risk capital is, okay, say whatever 50 million rupees or whatever it is, okay, then you carve it up, and I said you take only 1%. We can look at other methods later on about how to arrive at that 1%. You take only 1% of that 50 million rupees, and that should be your maximum risk on each trade, right? So that's what I'm talking about when I say budgeted loss. So this budgeted loss is the 1% of your total risk capital, which I've told you should be the maximum risk on each trade. That's your budgeted loss. So based on that, you place the stop. Actually, I haven't got into this, but actually what you should do is you should factor in a little bit of slippage in your budgeted loss in the way you size your position. Okay, so although you will place this stop that you place is based on the actual breach of the high and low, which I showed you yesterday, right? That you look at the chart and you see where the high and low is. Like here, if I'm placing this stop on on TCS, I will actually read off what is the low over here, what is the actual low, okay? And if the low is 2027, then I will place it at 2026.95. Are you following? 2027, if 2027 is the actual low, then I'll place the stop trigger level will be 2026.95, because there's 5% paise increments, right? It's trading in 5% paise increments. So because 2026.95 is the first point where it is lower than 2027. Are you following? The same thing we went through yesterday, right? Which Shuk was asking a question about why can't it be equal to 2027? But equal to is not lower than. Okay, we need to have a lower than, we need to have a lower low to break the trend condition.
Sir, in the case of we are dealing with huge amount of shares, so that in that case we will set stop loss at 20 more than something more than 2027. To
No. You can't place it more than 2027.
so to minimize that loss,
No. You have to understand the logic. One sec. That's why I'm emphasizing this point. Okay. You can't place it higher than 2027. Okay. Because what is the logic for placing your stop at just below 2027? Because 2027 is the previous low. So only when this market drops below 2027 has it violated the condition of the uptrend. Are you following? You can't place it above 2027 even though you think there might be some slippage, because then you're giving the order to sell your shares, because the trigger price is the point at which you give the order to sell your shares, right? You're giving the order to sell your shares when the trend has not really been destroyed. It has not been, the uptrend has not been neutralized. Are you following? Why have I bought? I bought it because, why do I have these 1000 shares long? Because my view was that we see this trend in operation and it has not, I don't see any evidence of it having been neutralized. Okay, so therefore I'm going to assume that, of course I could have also assumed that it is over, but I chose to assume. I looked at this trend, this high is even higher than this high. I see an uptrend going on. All the highs, all the lows are higher, all the highs are higher. So I choose to assume that whatever is going on will keep going on. Okay, like you have Newton's laws of motion, like body will remain in a state of rest or motion until there is some external force. Okay, so I just assume that it's going to continue in the same way. Okay, so I chose to assume that. So I should only exit my position. So based on that, I've gone long. Okay, because I think it's going to keep on moving in this way, that whatever low is formed over here, as you can see, when I bought it, it was over here. It did form a lower low compared to this, but it never went below this low. Can you see that? So the conditions of the uptrend were never neutralized. The conditions maintaining the uptrend were never neutralized or violated. So the uptrend remains in place, right? So the only reason I want to exit my position is if the market shows me that it has neutralized the uptrend or destroyed the uptrend. And that can only happen at, we are calling this 2027, okay, whatever the price is. Let's call it 2027. Doesn't show 2027, but anyway. So are you following what I'm saying? Okay, so therefore you cannot place it above 2027. That cannot be your trigger to start selling the shares, because you should only start selling when your assumption has been invalidated. Your assumption is only invalidated when the market makes a lower low than this 2027 level that we are calling 2027. Okay, we don't know what the actual low is. Are you following? Is everyone clear about this? Okay, so you can't decide to place it higher even though you are afraid there'll be some slippage. Is this clear? So the trigger level still has to be on a discrete break of that previous high or previous low. Okay, so in this case, if it's 2027, then my trigger level will be 2026.95. Right? Whatever be the in a different market, the increment may be 1 paisa, okay, or 1 cent or whatever. So you have to figure out what the increment is, and then just next increment is where you place the stop. Is this clear? Okay, everyone is following. Now, what I'm saying when I'm talking about budgeting for slippage, okay, when I'm talking about budgeting for slippage, okay, you have to assume that there will be some amount of slippage. So if you are triggering at if the stop trigger is at 54.50, you have to budget some reasonable slippage. So you have to assume, let's say that the actual execution of the stop will happen at 54.45 maybe.
That's what I'm doing.
No, okay, I understood as you as talking about, but 1 minute, let me come to that. But the trigger level will still remain 5450, assuming that this is a new low. Okay, the 5450 here is the equivalent of what I'm saying here is 2026.95. Okay, the equivalent of that is 5450.4. That is meant to be the new low. Okay, okay, just the next new low. Okay, so this will remain the trigger level. How you adjust for the slippage is where you adjust the position size. Okay, we'll show you later on. We already showed you how to adjust the position size. Remember, if you look at your somewhere in your calc, we did this calculation. Remember? Yeah, we did this calculation. Remember? So we are selling so many. This is your annual risk capital. Okay, so this is your annual risk capital. The 1% rule is applied, so 1% of your annual risk capital is what you are going to risk per trade. Okay, entry price, okay, whatever be the entry price that you are planning. Okay, entry price you can guarantee if you do take some risk, that what Garvit was talking about, that you want to buy something at 5501 when it is at 5521. Well, it may never reach 5501, it may go straight to 5700. That risk you take. But otherwise, using limit orders, you can guarantee the entry price. Okay, so you enter at 83, okay, and you exit at 68.5. Now here is where, this is when you're doing the budgeting of your when you're actually modeling your position size, okay, as a function of the other parameters. Okay, so here this is where you factor it in. Now this 68.5, okay, is not going to be the equivalent of the 5450.4. because this is only the stop trigger. You have to assume there will be some slippage. So you assume that the figure will be eventually, it will trigger, get executed at 54.45, let's say. Okay, so this thing that you put in here, the 68.5, this is going to be the equivalent of that 54.45. This is your projection of where the actual stop will get triggered, will get executed, not triggered. Triggered is 54.50. Are you following? So this is how you budget for slippage. You have to budget, because everything has to be done from, I'm teaching you speculation from a very conservative approach, but this will ensure that you never go bankrupt. If you use this kind of a conservative approach, I mean, your defense is very strong, you'll never go bankrupt. Okay, so you may make less money, but this ensures that you never go bankrupt. Okay, pretty much. Okay, if you can follow these rules. So this 68.5 exit price, when you are modeling the position size, okay, this thing that you enter in the exit price field is not the stop trigger level. It's not the stop trigger level. It's your projection of where you think the stop will reasonably execute. So in this case, you look at this and you say, okay, given this market, I think that given the size of my position, I think that 54.50, that's the trigger. The worst case execution for this is 54.45. Okay, I'm just giving an example. In real life, it may be better than that. Are you following what I'm doing? You're following the thought process? Yes, Pulkit, yes or no? Okay. Is this clear? So the 54.45 is what goes into this field when you are modeling the position size, because this here is all we are doing is modeling the position size. Okay, this is our goal actually. Okay, right? So here when you enter the projected exit price on loss, you enter the reasonable estimate with factoring in a little bit of slippage. You do not enter the stop trigger level. Okay, so if you are selling, you put it a little below the stop trigger level. If you are buying, you put it a little above the stop trigger level. You put in your reasonable estimate of where you think the stop will execute finally, at what price. Okay, and so that's what gives you the budgeted loss per share, which is 14.5. Okay, this is all pre-trade planning. So we are doing some budgeting of the loss. We are doing loss budgeting essentially, okay, or risk budgeting. So is this clear now? So now the reason I'm telling you to stick to liquid markets and stick only to the Nifty 50 is that here in the Nifty 50 kind of liquid shares, you're unlikely to have, because this is only your budgeted loss per share. Now when if the loss is, the stop is actually hit, there will be some actual loss per share figure. Now that is the actual loss per share. Now in a liquid market, essentially what happens is that your budgeted loss per share and the actual loss per share, there should not be that much difference. or even if the difference is there, it's in your favor, which means you actually end up losing less than you budgeted. Are you following? Okay, so this is the reason you want to stick to liquid markets, because here essentially what that means is you have low slippage. Okay, because in a liquid market anyway you would not have budgeted much slippage. Okay, you would have budgeted only a little bit of slippage, and therefore you have low slippage, and therefore you're able to stick to your budgeted loss plan is working out. Because remember that this is based on the idea that if you start losing much more than the budgeted loss per share, that means you're losing much more than 1% per share, 1% of your risk capital per transaction. Are you following? Because this is based on 1% per share. You're losing more than that, much more than that. Maybe you lose 2-3%. That upsets your whole risk planning, because that 1% actually eventually comes out of a projection about number of trades, percentage profitable trades, all these things. So it upsets all your risk planning if you start having huge slippage beyond your budgeted slippage. Is this clear so far? Okay, so these are all important concepts which make sure that you understand what we are talking about here. Okay, and one more thing that you have to factor in here, which we had not discussed the other day, is the brokerage. Brokerage also has to be factored into your risk planning, because brokerage is guaranteed. Whether you make a profit, there's this concept of, let me use this expression, I think it's there in your table as well. We still haven't gotten down to the, but we are discussing. There's another term that you're learning here, round turn brokerage. Okay, round turn brokerage means, in and out. Okay, so all transactions are in and out eventually. All right. So you have to, so the brokerage basically is your round turn brokerage. Okay, so you have to look at the round turn brokerage not just for the entry. So it is based on a per trade. They'll give you the figures on a per trade. Depends on how they display it on the website. But you have to keep your eyes on making sure that you understand that this is the total round turn brokerage. Okay, so you have to double the one side brokerage. Okay, for entry, for every time you trade this, you have to double that. Okay, because there will be an entry in it. So whether you're making a profit or you're making a loss, the broker will still take his commission. Okay, and that's not going to change. So you have to also factor in the round turn brokerage, which means essentially if you're losing 14.5 per share, maybe the round turn brokerage is 1 rupee, let's say. Okay, so maybe it's 1 rupee. So in this case, what you have to do is you have to reprogram this. It can't be 1000 divided by 14.5. Actually, it has to be 1000 divided by 14.5 plus 1 plus the round turn brokerage. Are you following what's happening here? Okay, so this is how you do comprehensive risk planning. Okay, so you have factored in slippage. Okay, here we should write this: exit price on loss including slippage. So to emphasize that this entry cannot be the stop trigger level. You have to factor in some slippage. Okay, so you see how comprehensively you're approaching your risk planning. Okay, first of all, what you're doing different from most investors. Okay, especially amateur investors, and even many professional investors don't use stops, which is why you see all these cases of funds losing huge amounts of money. There are funds which close down because overnight they lose 40% of their capital. Okay, there was one hedge fund called Amaranth, which had a huge bet on natural gas prices, and then they ended up losing 6 billion in like a couple of days. Okay, and eventually they had to shut down. So all these are all cases of poor risk management. If you can maintain this kind of risk management, the market can never do anything to you, because you're always trading in a very controlled manner. All you can have, the worst case outcome here is you have a run of losses. You keep on losing money. That can happen. But because you're bleeding a little bit only at a point of time, so you can only bleed to death in small cuts. The market can't just chop your head off. Okay, which happens if you don't have good risk planning. Okay, so you can have in trading, you can have these cases of you have a run of losing trades. But if you're betting a very small amount every time, then that should not upset your rhythm. Okay, are you following what I'm saying? So this is how you speculate in a professional manner with very tight control over your risk. Okay, so we have factored in slippage, we have factored in the brokerage as well. Okay, and then we have done this. Okay, so now you can see what is this actually. Loss per share, what is that? Number of shares. Okay, this is the total loss projected, okay? Alright, okay. So what are we saying here now? Where are we in terms of time? We have a little bit of time, so I have to show you the blotter as well. Okay. Now I just want to briefly. I don't know whether we should discuss this at this point of time, but we'll get into models later on. But understand here that what you're doing is you're actually modeling the position size. Okay. This is clear. You have to learn to use the language properly. Have you guys actually done models in finance? Have you done any finance models? Not yet? Okay, what is NPV? Is it a finance model? CAPM is also a model. Okay. So, but I don't think you guys have been taught the general properties of a model. How would you identify a model? Yeah, because you have not been taught the general properties of a model. So when I cover models, when we come to the buy-sell decision, okay, that's where models are really used most of the time. But you can see some cases where. But I'm just giving you a preview of models. It's very important to have a theoretical understanding of models so that you can identify a model when you see it. Now, just now you guys said that you have not done models in finance, but actually you have done it. IRR is a model. NPV is a model. CAPM, cost of equity in CAPM, is a model. Okay. APT is also a model. Okay. These are all models. Okay. So you've done models in finance, but you don't have. It's important to have a theoretical understanding of what a model is, a general theoretical understanding, so that you can identify a model when you see it, and you look at the component parts of the model. Okay. So this is the problem in a lot of the courses where even the external courses and all, where they talk about financial modeling and all, they're actually just teaching you a bunch of techniques, but they don't give you a good theoretical understanding of models. And they don't cover all the different types of models that are there. So we'll cover all that, but here you understand something very briefly, that here what are we modeling in terms of the way we use the language? What are we modeling here? This guy, the position size, okay, number of shares, yeah, 64.52. Obviously you can't do 64.52, so you have to no, this you have to actually do. What do we have to do here, guys? We have to do integer, basically. We have to integer this basic, but we have to sum down, right? Actually, we can't make it 63. It can't be 63, so we have to make it 64. Okay, so I've actually forgotten the formula for that, but that's what you have to do. You have to understand what you have to do. If you're clear about what you have to do, eventually you can find the syntax of the formula. Okay, so so this is the thing. So is this clear? So we are modeling in terms of the way we use the language here. We have modeled the number of shares for entry, the position size. Okay, this element here, which we have to put in all the time. The system defaults to 100, but you have to understand that you need to think about this actively and decide this figure. Okay, so this figure, how do you decide the number of shares to when you put on the trade? Okay, this is how you decide it. So this is how, here what we have done is we have modeled the number of shares, the position size. Okay, this is the position size. We are modeling the position size as a function of, what are the things? It's a function of what? You always model something as a function of something else. Okay, so whatever you're modeling is the dependent or independent? Dependent variable, and as a function of ABC, those are the independent variables. Is this clear? Okay, so we'll have some other terms for that also later on. So you're modeling this as a function of what all? Function of basically ARC. Okay, function of this also. What is that? Because this 1%, remember, is also a variable. You can change this. Okay, so it's a function of this, it's a function of this 1%, function of the entry price, exit price. Okay, loss per share is determined when you have exit price and entry and brokerage. So you don't put loss per shares, you put the primary variables. So if you have brokerage and exit price per, including the slippage. Okay, so actually your variables here are the brokerage, the projected slippage, the stop trigger level. Okay, then the entry price. This 1% variable, this is actually a variable. I made it 1%. Okay, but we can have different values for it. We can have it 2%, 3%. Okay, 0.5%. So as a function of this and as a function of the initial annual risk capital pool. Are you following? So these are all the variables. It's a function of all these variables. So we are modeling the position size as the function of all these variables. This is clear now. So this is also a case of modeling. Yes.
When did we decide that we have to take 1% or 2% or anything?
So we'll come to that. That's a longer discussion. So I haven't come to that yet. But that's why I've given you a thumb rule right now that you work with 1%. Okay. Basically, it needs to be a very low number. Okay. So I've given you a thumb rule. So is everyone clear about this? Okay. So we have covered bracket orders, we have covered this loss budgeting element. Now we also need to cover the blotter quickly. Okay, I want to make progress on other things, but I should cover the blotter quickly, what you guys should do, minimum stuff. Okay, so this is what Chug has done some work on this blotter, so I just changed his thing, so I've named the sheet. Okay, so date you can enter. Okay, date is not so important, ticker obviously is important. Okay, position size is position size. Here you enter minus sign. Okay, so if you're selling minus 100, minus 500, whatever it is, position you enter, you don't have to have a separate long position, short position, just enter it as a minus sign. Okay, then position size, actually this is not 45, so yeah, in India you can have 45 also. So let's say we enter this as minus 300. Okay, deal price, at what is the price at which you have entered the position. Okay, this is the entry price, you can call it the entry price also. So another shorthand for market lingo is price, shorthand is PX, order shorthand is ODA. Okay, all right, stop loss level, this is the trigger level. Okay, actually here what you have to do is, because we are going to use this later on to cover the maximal list, this will have to be the this will have to include the slippage and brokerage. Okay, I put in the brokerage here. What you can do is, basically you have to, eventually when you project the maximum loss, you'll have to look at the slippage and the round turn brokerage. I put in a separate column for round turn brokerage, so you can do your formula later on. Basically the stop loss level, then this can be just put as the including slippage only. Okay, not including brokerage, and then you add the brokerage because we got a separate column for that. Okay, then we have the round turn brokerage. Everyone understands the round turn brokerage. Figure it out from the IB website. Go to the IB website and figure out the round turn brokerage. Okay, cash impact, here again you put, if you are buying, you minus sign for longs. So if you are buying, the cash impact will be negative because it's draining cash. Okay, so your cash balance is going down, your asset mix is changing. Essentially, if you think of it in terms of a balance sheet, your asset mix is changing. It's going from all cash to some cash and some stock. Okay, are you guys following? Okay, so these are all the important things that you have to keep track of. This is good practice for you because it will help you. This is called a blotter. This is called a trader's blotter, where you keep track of all the trades that you're doing. Okay, so this will help you to keep track. This will be good discipline. It will help you to keep track and manage your risk also, right? Okay, hopefully once you take care of the initial risk budgeting and you place your trades in such a way that the maximum loss is already covered, okay, then that automatically takes care of your risk budgeting. A part of the problem that Tarun was having and you were also having is basically because I think he was focused more on the cash utilization and how much free cash was left to buy. But part of these problems which you were having in terms of looking at the mark to market on the system, okay, is because you are not doing this, you are not trading with pre-planned stops and all that, right? That's why you got out of control. Once you have pre-planned stops and everything is entered, the stop and the entry order, everything is entered together, then you can just forget about it. That trade is gone. Either it executes or it doesn't execute the initial entry order. Then you kind of replan. You have to keep reviewing the market, but basically you don't have to worry about it. Once your stop order is already in the market, you don't have to actively manage the risk. Are you following what I'm saying? This makes if you trade like this, it makes it much easier also to manage the whole experience, because for most investors what happens is trading is a very stressful experience, because you are losing money, then you don't know what to do, you are losing huge amounts of money, suddenly now you feel that, oh my god, it's such a big loss, how can I take such a big loss? Okay, so it's a very oh, see there what happened. See now we bought Maruti, so you can actually see a limit order execution in real time. Okay, so now you can see that it has bought the shares at 55.01 or whatever it was. You can see the trade log. Okay, So again, you can see that just to buy 100 shares, how many trades it has to do. Okay, so all right, so you can see this. All right, so we bought this. Now what was I saying? Anyway, the point I was trying to make is that if you trade in this kind of systematic manner by pre-planning your risk, always putting stop orders in the market, it makes your life as a trader much more relaxed. Okay, it's a much more clinical operation. Otherwise, you're always getting, you're being pulled apart by your emotions. Okay, so all this anxiety and all that. So it's not a good way to operate. It doesn't keep you, lowers the probability of success. Okay, so cash impact you can put. Initial risk you can factor in here as a function of the entry price, position size, and then the stop loss here, which stop level, including the slippage. But you have to add the round term brokerage. Okay, you have to program all this for yourself. This is your initial risk. Okay, and then this is stuff that you can do. You don't really have to worry so much. I mean, this is not a requirement. I'm not making you do it. But if you want to keep track, you can do this. Then the market price, you can do something else here. What is the current market price? Market price always means current market price. Okay, unless it's qualified. See, unqualified use of the term market price means current market price. Okay, otherwise if I want to say what was the market price at 11:23 a.m. on 2nd of April, then I'm qualifying it, and you know that it means that refers to that market price. So current market price, here you can use this concept of I have to see whether Sheets has it. So Excel used to have this concept of DDE links, dynamic data exchange. Okay, so you can actually link to that. You can just read up on the Excel manuals and see how it's done. Okay, so there are certain websites which give you the option of Yahoo Finance and all. Maybe they give you even the NSE might give you that option. You can just update, so the spreadsheet will update the live prices using those DDE links. Okay, so you can explore all that. This is part of your learning of spreadsheet software and how to use technology and all that. But the concept should be clear what you're trying to do. Once you do mark to market, once you do your market price, you have the concept of mark to market. Okay, which is where actually there's a problem with the system, because it is showing only day-to-day mark-to-market changes, so it gets you a little bit confused. Like you can see here in this, you can see obviously I'm making money on my TCS shares, because I bought TCS here. I bought it was somewhere here, 21 something, 2101 or whatever, and now it's 2187. I'm obviously making money. Okay, but it is showing me as having as a daily P&L status is what did I do? I just clicked on something and made it disappear. Okay, anyway, doesn't matter. It's showing me as a loss, but obviously because it's a loss from the previous day. Relative to the previous day's closing price, it's a loss today. Okay, so it must have fallen today. Okay, so yeah, because it's fallen today, so it's showing me as having a loss. So that's why. So that's why the mark to market is problematic. Because you want to have the market price, and you want to be able to calculate the mark to market on your own blotter, which will give you a more accurate value for your mark to market. Are you following? Mark to market is essentially nothing but, I think I have it somewhere here. So when we discuss positions and views, obviously we have a technical definition of long and short. Long means purchase of base asset, short means sale of base asset. Actually, this is the more more general definition. Okay, going long or short is making a bet that the base asset will appreciate or depreciate. This is the more correct definition, the more general definition. Okay, that taking a long position or a short position is basically betting that if you take a long position, you're betting that the base asset will appreciate. Okay, because in many situations like futures contracts, especially financially settled, cash settled futures contracts, you never take delivery of the asset. Okay, so the contract is only making a bet on which way the price will move. So the purchase of, so long and short essentially here means in more general terms. Okay, this is already mentioned, no? This part I can put into your notes here. So we are coming to the coverage of M2M. Okay. So this part is put into your notes. Okay, so this is the idea. Okay, so long and short, now you know, you can just read up on that. Okay, now there's this concept. Have you guys heard of M2M? M2M means mark to market, which is nothing basically. Just understand it. Okay. Let's put all this in there. Alright, so we'll just quickly cover this concept of M2M. M2M is what you do if you have, like here, where are we with the blotter? Okay, so in the blotter, this is the question that Tarun had, that he was not satisfied with the system's display of the M2M, okay, because it's doing it on a day-to-day basis. Ideally, you're right, we would want to have the M2M reflect the initial entry price only, the distance between the initial entry price and the current market price. So here you can learn a little bit more about Excel, investigate that DDE link if you want to, okay, how you get DDE links now and which websites give you that option, okay, and maybe even Money Control would give you that option. So you can put the market price over here, and then the M2M is nothing but the difference between the current market price and your entry price, okay. Then and because when you enter the position, let's at the instant that you enter the position, the market price is the same as your entry price at the very instant. Okay, if you look at 1 millisecond or whatever, okay, it's the same as the market price. The entry price, the market price is equal to your entry price, but then the market price starts moving around. But the entry price obviously never changes because it's just a transaction that you did. Okay, the entry price will not change, but the market price starts moving around, and then there's a divergence. Okay, so M2M is nothing but basically this. Okay. What you do, mark to market means marking to market. Essentially, you take the market price, you can see the market element of the definition. You take the market price and you revalue your existing position at the market price. So if you had gone short 300 shares at a price of 2208 and then the current market is 1700, okay, so you have to now initially that particular this 2208, okay, the cash impact, you have to in the cash impact you don't put in the brokerage in the cash impact maybe, and then you'll have to, otherwise you'll have to change this round turn brokerage, because this, if you put it in the okay, sorry, so I just confused you guys because this is for the risk calculation. So the cash impact should include the one side brokerage, okay, to be fair to the to reflect it accurately. And then what was I saying? Yeah, so the M2M will be just nothing but the same 2200, the 300 shares, okay, which you had gone short at 2200, but now you have to reflect the loss, the profit that exists on those shares between the current market, based on the current market price and the entry price. So this profit of 2200, where the profit gained by the difference between the 2200 and the 1700, that will have to be shown in the M2M. This is basically like your unrealized P&L. That's what it says here. The mark to market P&L essentially is the unrealized P&L. Okay, if you see here, now we talk about two things: unrealized P&L and the cash balance, which is the realized P&L. Okay, the realized P&L is basically relating to closed positions. Okay, essentially this will be reflected in your cash balance. Is everyone clear? Your total. There is a concept that you see here. This is the concept that we should cover now. So M2M, everybody is clear? Mark to market, nothing but basically taking the existing position and revaluing it at the current market. Okay, so if you have gone short at a much higher price and the current market is lower, you will see that M2M showing a profit. Mark to market profit, we usually show the mark to market profit or loss. Okay, we don't show the position value, we show the mark to market profit or loss. Okay, so in this case what we will have is basically this 2200 minus 1700 into the 300 shares. Is this clear? Okay, so you can write this in such a way, write the formula in such a way that when it's a loss it shows as a negative. Okay, that you can do yourself, you can program that yourself. Okay, so when you have the mark to market profit or loss, that represents your unrealized P&L. Okay, mark to market is the unrealized P&L. Where have I said that? Yeah, so the mark to market is the unrealized P&L. Okay, because remember this you have not locked in yet. This profit that you have, okay, whatever profit I have, let's say I bought TCS at 2101 and the market is now 2184, but I have not guaranteed this profit for myself because I have not sold my shares. So the position is still open, right? Position, you guys understand? Okay, so the position is still open, so I've not guaranteed these profits to myself. Okay, so therefore the price is still fluctuating. That's why it's showing in the mark-to-market P&L, and that's why it's an unrealized P&L. That's why we say the mark-to-market shows you the unrealized P&L. Unrealized because the position has not been closed, and therefore you have not locked in that profit. So these are the expressions that we use, that the profit has not been locked in, okay, because the position has not been closed, okay. So it is still an unrealized profit, okay, which means you have not realized the profit. Are you following the word realized? Okay. So mark to market is basically your the unrealized P&L. Okay. So what we should do here is also connect to the idea of NLV or NAV. So IB, you will notice the IB TWS shows you if you click on the account, you'll see a NLV figure, net liquidation value. Okay, the more general term that we have in the industry is NAV. You might have heard about NAV of mutual funds. Some of you who did research on mutual funds. NAV is basically net asset value. Okay, so let me just write it here. Net asset value, and all that it is it's the sum of your realized and unrealized P&L. Okay, so you may have made some losses which would have taken down your cash. Your initial cash balance is $1 million. Maybe you made $100,000 worth of losses. So your cash balance is down to 900. Okay, I'm assuming no brokerage here. Your cash balance is down to 900,000. Okay, and then you have 100,000 of realized losses. But maybe you have an open position on which you are showing 400,000 of profit. Okay, so your NAV is going to be 1 million minus 100,000 realized profit plus the 400,000. So your NAV will be showing as 1.3 million, right? But you have to understand that the 400,000 is basically not guaranteed because it's an open position. So the price can start fluctuating, and then your profit might actually reduce or it might increase. You don't know what will happen, but the point is that you haven't locked it in. So it is unrealized P&L. So the important term we need to know is net asset value of any fund that we are talking about. Any fund where we talk net asset value has two components. One is the unrealized P&L, which we refer to as the mark-to-market P&L, and then then there is the realized P&L, which is all your closed positions, which shows as your cash balance. In some accounts, they will show it as a cash balance, right? Right? Like Rajan saw a cash balance on that account which I was showing you, the Oanda FX trade account. You saw a cash balance. That is the cash. That's all the realized P&L. Okay, right? Is everyone clear about this? You're following so far? Okay. So this blotter that we have talked about, this you can just keep for your own. I'm not putting any constraint on you that you have to keep it, but I think it's a good practice. It'll get you into the habit of tracking your positions. Okay, and you can figure out for yourself what you want to see. Okay, if you are very particular, like Tarun may be very particular about wanting to see the actual M2M, in that case he can set up the DDE links and make sure that his actual market price comes in. Okay, maybe even IB will offer you DDE links. You can just read the website and figure out. These guys are so advanced, they should be able to offer you the DDE links directly. Okay, so and then so this is basically it. Now where are we in terms of time? We have 4 minutes. Oh, great. Okay. 1 minute. We have so many things to cover. We have a lot of ground to cover. Charts. I need to quickly cover charts. Okay. So we are looking at time series data charts. Okay. 4 elements of a chart. I'm going to quickly cover it now itself. Okay. So you realize how this stuff is being done. It is being done very quickly. I'm just throwing concepts at you. If you don't understand, you should ask immediately in the class. Good that we are getting a lot of questions. But then go home and revise. Make sure whatever concepts have been taught, that you have internalized them. You can do it with your hand tied behind your back. Right? So, okay. Now, what are the elements of a time series chart? Okay, initially we mainly in finance we do use cross-sectional data charts also, but we use a lot of time series data charts. Here is a time series data chart, TCS, okay, because you have one variable over multiple periods of time. at least one variable over multiple periods of time. As I showed you, if I compare this to the NSE, that is still a time series data chart. Okay, because it fits the definition of at least one variable. Two variables is covered by at least one variable, right? So I can show all kinds of, I can show all the IT stocks. I can show all the IT stocks, Infosys, Tech Mahindra, everything here in one display. That's also a time series chart, okay? All right, what are the elements of a time series chart? Data range being graphed. So we want to use this exact term, data range. Just nothing but start date and end date, okay? For most charts that we use in finance, the end date is very easy, it's the current period, okay? Most of the charts are have live data, okay? So it's the current period. So the end date is the current period and it's just the beginning. Here we don't know exactly what it is, around 17 July 2018, okay? So this is your data range, July 2018 to today. That's your data range, end date minus, okay. What is the market of variable being plotted? Okay, in this case the variable is TCS common stock. Okay, this is the variable. Now I can change this around and make it dollar yen. I can make it West Texas crude oil, whatever it is. Then the market changes, right? Everyone is following so far? Okay. What else do we have to plot type? Okay. The plot type is, what type of plot is this? Which is here, okay? You can actually do this even, you can do it with this one also, okay? We can look at it, this is actually a candle chart, okay? This is one type of display which is a candle chart. You can play around with this and see where you have the different types of plots. But plot type is basically how am I going to display the data? How am I going to display the data? I can also show something which is just a line chart. This is also a candle chart. I can just make it a line chart. Everyone knows what a line chart is, okay? Because I just plot the closing price for each period. That's a line chart. It's the simplest kind of chart. I capture only one type of data, which is the closing price, okay, at the end of one period, okay? But in the case of a candle chart, I am plotting all kinds. There you have your data. But I'll just quickly finish this. Since you don't have any other class after this. Okay. All right. Okay. We'll continue in the next class. Okay. You want to listen to the bell a little longer? No, I don't think this alarm has a music option. I don't want to encourage you guys with the music and all that because